Bismillahirrahmanirrahim. Assalamu alaikum, everyone. I welcome you all to the follow-on session of Conceptual Framework. Now, in our last session, we had already studied how the IAS and IFRS are made, what is the regulatory framework, what is the conceptual framework, how IASB functions, who sets the accounting standard, and so on and so forth. Now, we need to continue working on this particular topic from an examination point of view. So we are going to attempt the examination kit. We are going to see multiple MCQs that are available on this particular topic, conceptual and regulatory framework in your examination kit, Kaplan examination kit in particular, and we'll see how much can we solve it. Now, bear in mind during this session that we are going to solve questions based on what we already know from our previous lecture. And yes, we are also going to obtain further knowledge which I'll be delivering while solving some of the MCQs herein, right? So let us just continue, my friends. Okay. So the first MCQ that we are going to attempt from our Kaplan examination kit is as follows. It says that which of the following statements relating to regulatory framework is or are true? So which of the following is or are true? Number one, accounting standards on their own provide a complete regulatory framework. No. Accounting standards only provide you the relevant practice, the relevant practice that has to be followed. But what is the underlying framework of how accounting standards will be made? What is going to be the structure of those accounting standards? To what extent each and every accounting standard has to make sure that some answers are given towards a particular accounting problem? These are all set separately in the conceptual framework. So accounting standard themselves do not provide you a framework. There is a separate Bible document which is known as the IASB's conceptual framework, which provides you the underlying framework of reporting. Yeah. So the first option is basically false. Next is a regulatory framework is required to ensure that financial reporting meets the need of primary users. Now, my friend, this particular question basically is that a regulatory framework is required to make sure that everything goes according to the purpose of financial reporting, and that is true. That is how things work. Yeah. Now let's move on. Question number 39. The International Accounting Standards Board, IASB, that is IASB's conceptual framework for financial reporting, lists two fundamental qualitative characteristics of financial statements, that is relevance and faithful representation. Relevance and faithful representation. Yeah. So I'll just give you a recall of what relevance and faithful representation exactly was. So one of the first fundamental qualitative characteristic of IASB's conceptual framework was relevance. And by relevance, the IASB's conceptual framework focused on the fact that each and every relevant information should be reported in your financial statements. And relevant information is any information that affects the decisions of users of the financial statements. Affects the decisions of users of financial statements. Yeah. And you had to take care of materiality in relevance as well. So the thresholds that make you decide that what is relevant and what is not relevant, both based on qualitative terms and quantitative terms, that was part of relevance. And when you talk about faithful representation, any relevant information had to be reported as per your conceptual framework, and that also had to be reported faithfully. That also had to be represented faithfully. And for an information to be faithfully represented, it must be complete, it must be neutral, right, without any bias or preferences, and it should be reasonably free from error. It should be reasonably free from error. Remember? Yeah. So these three requirements had to be met. Now let us just see what the examiner is asking for. Place the qualities listed alongside the appropriate qualitative characteristics. So you have two options, faithful representation and relevance, and you need to decide which component goes into which heading. So completeness, where does completeness go? Completeness, as I just mentioned, completeness goes in faithful representation. Neutrality also goes in faithful representation. Now, where does predictive value go? Predictive value goes in relevance. Sir, how come we did not study anything about predictive value while we were studying the conceptual framework? Actually, indirectly, we did study about predictive values. You remember we studied about materiality. Now, during materiality judgments, you need to assess if a certain value meets the quantitative threshold, yes or no, or if it meets the qualitative threshold, yes or no. So this is the prediction, this is the judgment that you make. And that is why predictive value always goes under relevance. It is part of relevance. You have to predict that this value based on your judgment is relevant, yes or no. Now let's move on to point number 40. The International Accounting Standards Board's conceptual framework for financial reporting identifies qualitative characteristics of financial statements. We know that. Which two of the following characteristics are not fundamental qualitative characteristics according to IASB's conceptual framework? Which two of the following are not? The easier way is to identify which of the following are. So relevance and faithful representation are fundamental qualitative characteristics. That means reliability and comparability are not relevant qualitative characteristics, and therefore these two are the answer. B and D are the answer. Okay. I'm just doing this very quickly because we have already understood everything in the lecture. So we need to make sure that we save our time, we optimize our time and do the relevant questions pretty quickly. So here it says that you need to match the elements to the correct definition according to International Accounting Standards Board's conceptual framework for financial reporting. Now you can take, as a student, you can take time and eventually decide that, which element has to be matched with what definition, but I may do it quickly for you. So it says that a present economic resource controlled by the entity as a result of past event. So this is asset. Remember, a present economic resource which has the potential to provide you future economic benefit. Yeah. So this is asset. Okay. Next, it says the residual interest in the assets of the entity after deducting all its liability. So asset minus liability is equals to capital, or capital means equity. That means that this option relates to equity. This option relates to equity. Matched. Then a present obligation, blah, 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 blah. Present obligation means that definitely this is liability. Matched. And for sure, the last one would be expense. You can read it down. You can, based on your own feasibility, you can just read it down and make sure that you understand all of them. But yeah, I've done quick clear for you. Let's move forward. Which of the following explains the value that relevant information contains? Remember that relevant information is any information that affects the decision of users. And while assessing which information is relevant, you take materiality judgments. You make materiality judgments. All right. So which of the following explains the value of relevance? Instructive value, fair value, confirmatory value, or approximate value. Now, what should be your answer? Basically, it is confirmatory value. Now, you must be thinking, sir, that what is confirmatory value? You see, by definition, confirmatory value is any value that, how do we say it, that actually ensures the reliability of past information. Yeah. So confirmatory value, the concept of confirmatory value is that entities report the consequences of decisions made earlier on. So, for example, a company decided to pay a dividend of $10,000 in the upcoming year. The company, on the year end, the company decided that this is year end 31st December 2010, and we will be paying a dividend of $10,000 after the year end. So, for example, this dividend was actually paid on March 2011. Now, despite the fact that the decision to pay dividend was already made on 31st December 2010, despite this fact that the decision was already taken by the users of the financial statements, by the shareholder themselves to pay dividend, they already took this decision last year. But still, since this transaction took place 3 months after, in March 2011, still this information is relevant and will be reported within the financial statements. Information is relevant and will be reported within the financial statements. Now, since this transaction took place during the year, the dividend paid will be recorded in the year ended 2011. And the transaction, when shown in 2011, this will confirm the decisions taken by the users in last year. And this is for everything. For example, one company, the board of directors of a company decide in 31st December 2011, they will be disposing of their property, plant and equipment in the upcoming year. Now, although the users have already taken the decision, so if they have already taken the decision, theoretically, it does not make any sense to tell them in the upcoming year that we actually sold this asset. Yeah, someone might argue, sir, the users, the shareholders already made the decision to sell this asset. Even if you really sold it in 2012, why are you actually telling them that the disposal was made during the year? Because we think that this is relevant information. This provides the confirmation to the users of financial statements that whatever the decision was taken in past year, it has been implemented in this year. So it provides them a confirmatory value. It is relevant information, though its decision was taken in past. Still, since the transaction was executed this year, it is relevant to be shown, and we show it because it is a confirmatory value. It confirms the decisions made yesterday. So the answer is basically C. This is something new that you learn. Some people asks me normally that, sir, what is confirmatory value? Now I have given you an example of multiple examples of what can be confirmatory value, and also explained you this MCQ. Yeah. So move forward. Let's move forward. Which of the following is an example of the following principle of faithful representation? Which of the following falls in faithful representation? Okay, so we don't have to actually do this. This is not marked. We are not doing this right now. Actually, practically you cannot solve this MCQ right now. This is why we are, just skipping this off. It is related to conceptual framework, but you see, you haven't actually studied IFRS 16, or for example, convertible loans IAS 32, or for example, IAS 37, or IFRS 15. You haven't studied these accounting standards now. So let us just leave it for the time being, and we will discuss it later on. Don't worry. Let's move on. A forum for consultation with parties affected by the work of IASB is provided by 1, 2, 3, 4. Which body? Option number 1, IFRIC. No. You see, the International Financial Reporting Interpretation Committee reports to the IASB itself. So it is not a consultative committee. It is not a consultative committee where people come in and they say that IASB did this thing right or that thing right, or they are doing this right or wrong. No. They don't discuss this. Yeah. So since IFRIC itself reports to the IASB, therefore IFRIC is not a consultative forum where people consult about the decisions of IASB. IFRIC is just a sub body of IASB itself. This is not the option. Yeah. All right. So the IFRS Foundation, no, IFRS, under IFRS Foundation, there are the bodies. The IFRS Consulting Committee, there is no such committee as such. The correct answer is IFRS Advisory Council, which is a forum where parties, including accounting bodies and practitioners, sit together to address issues of IASB. So this is the advisory council for you guys. Okay. Let's move forward. Which of the following criteria need to be satisfied in order for an element to be recognized within the financial statements? Which of the following criteria need to be satisfied so that that element is recognized in your financial statements? Yeah. So you remember there were two fundamental qualitative characteristics. Fundamental qualitative characteristics means that financial statements need to have those characteristics at all times. And one was relevance and the other one was faithful representation. So for sure, answer number 5 is going to be the option. Remember, which of the following? There are 3 choices in each of the options. So there needs to be 3 answers. 1 to 4, 1, 3, 5, 1 to 4, 1, 3, 4. So in each of the options, there are 3 choices, right? There are 3 variables. So faithful representation and relevance has to be there. Because these are the fundamental qualitative characteristic. Any item can be recognized when and only when fundamental qualitative characteristics of financial statement are being met. So 2 and 5 needs to be there. Now there are only 2 options in which 2 and 5 are present together. So either your answer will be A or your answer will be C. Now the only option rather, this is 1, 2 and 4. The only option possible in this case is 1, 2 and 5. So even if you weren't able to guess point number 1, still through point number 2 and point number 5, you should have guessed the right answer. Point number 1 is that it meets the definition of an element of financial statement, which is very much common sense. You can only recognize an element into your financial statements once it meets the definition of an element. An asset needs to be an asset, a liability needs to be a liability, an income needs to be an income, an expense needs to be an expense, and equity needs to be an equity, so that they are recognized in financial statements. So, even a dumb person with some knowledge of the lecture could have done this. This is the right way to approach such type of questions. Whenever there are multiple choices given, just go for your best gut feeling that what should be mandatorily be there. And if had someone identified that, okay, by all means, option number 2 and 5 needs to be there, then it was easier to determine that only option number A has an option where point 2 and 5 are there. So your correct option is A. Okay, let's move forward. Point number 46. So which description defines information that is relevant to users of financial statements? Which description? Information that is free from error, bias, and faithful representation of events? No, this is faithful representation. This is not relevant. In order for an information to be relevant, it must be such an information which affects the decisions of the users of the financial statement. Yeah. Information that has been prudently prepared? No. Information that is comparable from one period to the next? No, this is comparability, enhancing qualitative characteristic? No. Information that influences the decision of users? This is the correct option. D is the correct answer. Now, you can only do such type of MCQs once you have listened to my lecture of conceptual and regulatory framework. Otherwise, you cannot solve, this examination kit, and you can technically not solve your examination. So then there is question number 47 in front of you. Which description is most representative of the accounting framework used under IFRS standards? Principle based framework or legal obligation? Yeah. So now we need to discuss this, please. I've just added one page and I'll try to spend some time on it. What the question is, what is the IFRS approach? Now, my friends, there are practically two approaches to accounting or two approaches to financial reporting in the whole world. One is called principle based approach. One is called principle based approach. And the other one is called legal approach. Yeah. Or rather called rule based approach. Rather called rule based approach. Yeah. So for example, IFRS follows IAS and IFRS follows the principle based approach. Now, the methodology of IAS and IFRS is that they give you some criterias and then the accountant has to make their own judgments that how this transaction should be recorded. You see, many accounting standards do not even define what entry should be made in particular. Many accounting standards do not define that, okay, you have to follow step number 1, step number 2, step number 3, step number 4. It's not the case. For example, if you talk about IAS 36, I'm just referring it for now. IAS 36 is impairment of assets. And it says that you should perform impairment whenever there is a hint of something going wrong. So it's not a rule based approach where you have to make an impairment test each and every year. It's not a rule based approach. The accountant has the liberty to take his own judgment and decide if an impairment test is required. I'll give you another example. So, for example, if you remember IAS 2, there are two approaches to value your inventory. FIFO, LIFO is not there, and FCO. The accountant has the liberty, the entity has the liberty to decide which of the model you have to follow. You have a choice. So it's a principle based approach under IAS 2, where they tell you what are the advantages of FIFO, what are the disadvantages of FIFO, and what are the advantages and disadvantages of FCO, what happens in the times of rising prices, what happens in the times of falling prices. And then it is up to the accountant to use the best model it deems for its particular entity. It's a principle based approach. They teach you everything, they tell you everything, they tell you advantages and disadvantages, but at the end of the day you have to make your own judgment that what is right and what is wrong. Yeah. So some of the advantages of this model is that it is flexible. Yeah. It is easy to adapt. By easy to adapt, I mean accountant can make judgments. Accountant can make judgments even when the accounting standard is silent for a particular transaction. So since the application of IAS and IFRS is a principle based approach, you can also apply judgments, you can also apply best knowledge into scenarios where the accounting standards are silent. For example, let me give you an example, cryptocurrency. Now, there is not even one accounting standard till today's time which specifically talks about crypto assets. There is no accounting standard which specifically talk about crypto assets or non-fungible token and NFTs. There is no specific asset for that. So there is no specific standard for that. But the accountants have principle based knowledge of various accounting standards, and they have the knowledge of conceptual framework and regulatory framework, and therefore they have the flexibility, they have the freedom to adapt whatever knowledge they have into the scenario, and then even they can apply the correct accounting treatment in such scenarios where a particular accounting standard is not available. So for example, as I just told you, for crypto assets there is no particular accounting standard available to date. So there have been accountants, practitioners and experts who have written down that see such type of assets can be carried out under IAS 38. Now, the standards are silent over it, but people use their own knowledge and judgments and principles to define that IAS 38 would be the best possible accounting standard to apply on crypto assets. Yeah. Now, such flexibilities are not there under a legal approach or a rule-based approach. Now, US GAAP means generally accepted accounting principles. In US, the US GAAP is merely a rule-based approach. They tell you exactly what to do. They tell you exactly what to do. They tell you that you have to follow, for example, FIFO or LIFO for inventory valuation. They don't give you options. It is a rule-based approach. They tell you that, for example, for PP&E, property, plant and equipment, only cost model has to be followed. And only this type of depreciation can be applied. For example, financial instruments have to be carried at this value. For example, intangible assets have to be carried at this value. For example, in as far as I remember, I may be wrong. Don't actually catch me if I go wrong. What I remember under US GAAP, intangible assets had to be amortized on a certain life, and it was pre-decided by the US GAAP. Yeah. So in IFRS, you have the liberty, you have the principles based, you have the knowledge of accounting, you know what is matching concepts. And so the IFRS gives you the liberty to decide what is the actual economic useful life, where you would be earning economic benefits. And in order to match that, you can determine the useful life for the purpose of amortization. But that not happens in US. US GAAP tells you, I may be wrong, but for any particular GAAP, I've certainly read that there is a particular guideline which says that only this much years you can use for amortization of intangible assets. It is a rule-based approach. Now, a rule-based approach, might be advantageous. A rule-based approach might be advantageous in growing economies, in growing or less formal economies. If you feel that your accountants or your business structure or your economy is not well tied up, and it is necessary to dictate the economy that what is right and what is wrong, what needs to be done, then maybe a rule-based approach, as in US GAAP, might be better to be followed. It may be a better approach. Less formal economies, it may be a better option. But for example, an economy like US, it does not make any sense. So the disadvantage of following such a technique is that what happens when there is no rule for a particular transaction. So this has happened many a times in developed economies, my friends. This has happened many a times in developed economies that, people said that we did not account for this transaction on a prudent manner. We did not create this provision. We did not recognize this asset. We did not recognize this loss because it was not required by the GAAP. It was not required by the local accounting standard. So in a rule-based environment, you cannot penalize an entity for something which was not written in the rule book. In principle based approach, people use their judgment to go for the best accounting, to go for the most faithful representation. They have to apply faithful representation. So they don't wait for laws and regulation and rules to come in. But in a rule based approach, if there is no accounting standard for a particular type of transaction, they would just not account it. They would just keep that thing outside the books and say, we cannot help it. We cannot help it. It was not written in the rule book. So it is problematic. If you ask me, which it has been proven over many years now that a principle based approach, specifically that followed by IAS and IFRS, is a better approach. Yeah. So yeah. So once this is understood, let us just go back onto the question and see what should be the answer. So it says that which description is most representative of the accounting framework used under IFRS. So IFRS basically follows a principle based framework rather than a legal based or a rule based framework. Okay. So I told you that we are going to learn some new things, and yes, we have done this. Okay. Now let's move forward. So it asks you which of the advantages below is or are likely advantages of the global harmonization of accounting standards. What is the clear-cut advantage of global harmony of accounting standards? So option number 1 is greater comparability between different firms. Yes, this is an advantage. As many companies follow IAS and IFRS, it makes the information more comparable. Remember that comparability improvement was one of the prime factors why conceptual framework and financial reporting was actually released. Because before IASB was there, before IAS and IFRS was there, different company used to follow different formats and different accounting principles, and that made very much difficult for investors to identify if an investment was right or wrong. Then greater comparability within legal systems. No. You see, IAS and IFRS are primarily related to accounting. The whole legal structure is still different within for every country of the world. So the legal system does not match just by applying or IAS or IFRS. That is not true. Easier for larger international accounting firms. Yes. So there are larger international accounting firms. So it has become easier for accounting firms to grow big, since almost everywhere in the world IAS and IFRS are followed. Okay. Then, which three of the following are advantages of applying a principle-based framework of accounting rather than a rule-based framework? Which three of the following are advantages of applying a principle-based framework? It avoids firefighting, where standards are developed in responses to a specific problems as they arise. In my own personal opinion, yes, it actually helps you. Because in a principle based framework, the conceptual framework is already there. So even if a new type of transaction like cryptocurrency comes in, you rapidly on a firefighting basis do not need to develop an accounting standard. People and accountants can make their own judgments like they did for crypto assets and NFTs, and they made their judgment of which type of accounting is the best one, and so they follow it. So you don't need to develop accounting standards in a hurry. This is a clear-cut advantage. Yes. It allows preparers and auditors to deal with complex transactions which may not be specifically covered by an accounting standard. Yes, even if a transaction is not specifically covered by an accounting standard, conceptual framework and IAS and IFRS gives you the liberty and adaptability to to develop accounting where the accounting standards are specifically silent. So B is option is also correct. Principle-based standards are thought to be harder to circumvent. So it's harder to actually, manipulate. It's harder to manipulate principle-based standards. Yes. A set of rules is given which attempts to cover every eventuality. Principle-based frameworks are not a set of rules. They are a set of principles. They are not a set of rules. Therefore, option number D is not correct. it is easier to prove non-compliance. No, actually, it's harder to prove non-compliance in a principle-based framework. So only three options had to be there in your answer, and option A, B, C is the correct one. Okay. 50. Yeah. Which of the following is not a purpose of IASB's conceptual framework? Which of the following is not a purpose? I'll just read it down hurriedly. To assist the board in preparation and review of IFRS standards, this is their job. You have to select which of the following is not a purpose. Okay. To assist auditors in forming an opinion, yes, it helps. Conceptual framework helps auditor to form their opinion, because auditors know what are fundamental qualitative characteristics and what are enhancing qualitative characteristics. So it is easier for them to audit. To assist in determining the treatment of items not covered by an existing IFRS standard, yes, IFRS also allows that. Again, you need to select that option which is a not helping conceptual framework item. To be authoritative, where a specific IFRS standard conflicts with the conceptual framework. No, the conceptual framework is not authoritative. Even if there is a conflict between conceptual framework and IAS and IFRS, you remember from my lecture that IAS and IFRS prevails. So IAS and IFRS prevails over conceptual framework. Okay. So conceptual framework is not the authority. The option is D. Yeah. So this is the wrong answer, and therefore the option is D. Let's go for item number 51. Which of the following bodies is responsible for funding the other bodies, as well as aiming for convergence between national and international accounting standards? IFRS Foundation. It is very easy. IFRS Foundation has the core responsibility to raise funds for IASB and other bodies. They have the responsibility to create a national and international convergence. Convergence actually means they have to create collaboration. For example, for many years, the IFRS Foundation has been trying to collaborate with the FASB, which is the Financial Accounting Standards Board of USA, to develop common set of accounting standards. You see, most of the world, like if you talk about UK, even Canada, Australia, Pakistan, India, almost hundreds of countries in the world at this moment in time follow IFRS. But on the other hand, US, which is such a big economy in its own regard, does not follow IS and IFRS. So IFRS Foundation, which is the daddy organization, it is responsible for creating convergence or collaboration with the US body to create common set of accounting standards, so that the largest economy of the world also comes on to IFRS. And so technically one accounting standard shall prevail all over the world. That is the whole objective. Okay. So IFRS Foundation is responsible. Then let's go on to 54. Which of the following is not, again, a not question. Which of the following is not included in the IASB's definition of an asset in the conceptual framework for financial reporting? Which of the following is not an option? The asset is controlled by the entity. The asset is a present economic resource. The economic resource can be reliably measured. This is not within the part of definition of asset. Not within the definition of asset as measurement of assets is defined under their relevant accounting standards. Remember, conceptual framework, the definition of asset does not define the measurement of specific items, specific assets. For example, if you have an asset which is inventory, its valuation is carried under IAS 2. If you have an item of asset which is property, plant and equipment, it is measured under IAS 16. If you have an item which is an asset and it is an investment property, it is carried under IAS 40. So the measurement techniques are defined by relevant accounting standards. It is not covered within the definition of an asset under the conceptual framework. So C is the correct option. You had to select not. All right. Yeah. So MCQ number 55 is also for your learning. It's very important. It will take a bit of time. So make sure that you listen to me very carefully. Increasingly, the International Accounting Standards Board is requiring or allowing current cost, there is a new terminology coming into play, current cost, to be used in many areas of financial reporting. So increasingly, there has been a concept which has been generating in the world for some time, which is known as the concept of current cost accounting. And I'll take your time here. You see, there is a discussion or there is a relevance going on between two types of accounting. One is known as historical cost accounting or historical cost concept. Yeah. And the newer concept, which is developing day by day, it is known as the current cost concept. Now, historical cost concept means that you apply the formula on your assets as below. Historical cost, that is the cost that you paid to purchase the asset. For example, 5 years back, you bought a building. So historical cost means the cost that you paid to buy that building 5 years ago. So for example, you paid $500,000 to buy a building 5 years ago, and the life was 10 years. Life was 10 years at that time. Historical cost concept says that the formula would be historical cost minus accumulated depreciation. So what would be your accumulated depreciation? Your accumulated depreciation would be, there is an asset historical cost of 500,000 divided by 10 years. And since there have been 5 years till now, you will multiply that by 5 years. So per annum depreciation, my fellows, would be 500,000 divided by 10, 50,000. Multiplied by 5 years means that 250,000 worth of depreciation. And hence you will report a net book value under the historical cost concept of 250,000. I will again calculate how this 250,000 was calculated. You had a historical cost of 500,000. Accumulated depreciation was 50,000 per annum. The cost was 500,000. Life was 10 years. That means 50,000 per annum depreciation. Multiplied by, for example, 5 years till now. So that means 250,000 depreciation would have been charged. And the depreciated historical cost, the net book value you would have would be 250,000. And this is reported in your financial statements. Now we routinely follow, remember guys, we routinely follow the historical cost concept. And most of you guys wouldn't have even heard of the current cost concept. This is a newer concept which is being discussed nowadays. Under the current cost concept, you apply a different formula. And that formula is different formula for assets. You take depreciated current cost. you take depreciated current cost. So depreciated current cost means that you determine the current cost of this asset, that is the fair value. So you determine that if that asset, that building is being bought right now, you just imagine that had I been buying the building I bought 5 years ago, had I been buying it right now, what would have been the current market value? You determine the fair value, the market value. For example, now the same building which I bought for 500,000 5 years ago, for example, the same building is worth 800,000. You will take the current cost at first. Although in reality, you would have acquired the building 500,000 or $500,000 5 years ago. But the current cost concept, which is a developing concept, it has not yet been fully applied into the reporting world. But it says that you determine the value of your asset or in today's time. And for example, in today's time, the same building is worth 800,000, and you think that had this item been depreciated over 10 years, had this item been depreciated over 10 years for 5 years till now, what would have been the depreciation? So the depreciation would have been 800,000 divided by 10 years. And since 5 years have passed till now, then the depreciation would have been 400,000. 400,000. So according to current cost concept, your depreciated current cost, your depreciated market value, or you can say the net book value to be reported in your financial statement should be 400,000. So there is a new concept in the market which is known as current cost concept. And according to this concept, you don't depreciate your historical cost. Rather, you depreciate the current market value. You take the market value of a new asset and see and imagine that had I bought this asset in today's time and used it for 5 years, what would have been its value? And its value would have been $400,000. And according to current cost concept, this is the value that should be reported in your SOFP. This is the current cost concept. Now, at this moment in time, in today's time, we are not discussing which model is the better model. But yes, current cost concept is being discussed nowadays. Now, if you understand what we have discussed right now, let us just go back to the MCQ and discuss what your examiner is saying. Your examiner is saying that Drexler acquired an item of plant on 1st October X2. Remember that your year end is 30th September X4, which means that you bought this asset 2 years ago. This asset was bought 2 years ago. So 2 years worth of depreciation has to be charged. Drexler acquired an item of plant on 1st October X2 at a cost of 500,000. So this is your historical cost, right? It says that it is being depreciated over 5 years using straight line depreciation and an estimated residual value of 10% of its historical cost or current cost as appropriate. So just imagine if you are following historical cost concept, your depreciation per annum would be as follows. You take the cost $500,000. 10% is the residual value. So 50,000, which is 10% of 500,000, is the residual value. And you depreciate it over 5 years. So 450,000, if you do 450,000 divided by 5 years, this would be 90,000 per annum. All right. It says that as at 30th September X4, which is the year end, the manufacturer of the plant still makes the same item of plant and its current price is 600,000. Your examiner is saying that if you were to buy, I am using just a different pen. if you were to buy the same asset now, then according to the current cost, it has a value of 600,000. And if you calculate depreciation per annum on the same format, then this would be 600,000 cost minus scrap value, and scrap value would be 10% of the current cost. So this is 60,000 and divided by 50 years, this would be 540 divided by 5, and this would give you 108,000 depreciation per annum. Now your examiner is asking you, what should be the correct carrying amount to be shown in the statement of financial position under historical cost concept and current cost concept? And you need to select the correct option. Under historical cost concept, the carrying value of the item after 2 years of 30th September X4 should be, you had a, sorry, I'll use a different pen. The cost was 500,000. Yeah. The accumulated depreciation of 2 years would be 90,000 into 2, that is 180,000. And if you subtract 180,000 from 500,000, you will get a net book value of 320,000. So for historical cost concept, 320 should be the answer. And what should be the value of your asset if the company was following current cost concept? Then the value should be cost would be 600,000. The current cost would be 600,000. The accumulated depreciation of 2 years, per annum depreciation is 108,000 into 2. That means 216,000. And if you subtract 216,000 from 600,000, your net book value would be 384,000. So your answer should be 384,000 in the case of current cost concept. All right. Good. So this is a newer concept that you have studied with me, and it will certainly help you at least score 1 or 2 or 4 marks in your examination. If this comes, you need to know this. Okay. This is part of your course outline, and maybe a newer concept for many of the guys. Let's move on. Okay. So now we'll just go till 59, and that is it for framework of our examination kit. We have done many MCQs, and I certainly think that your framework has become stronger than before now. So which of the following items should be recognized as an asset in the statement of financial position of an entity? It is so. We are not doing this right now. Not doing this. Skip this for now, my friends. Why? Why we are skipping this for now? Because I see that, factoring and government grants, you haven't studied till now, right? So let's just skip this for a while. This is IAS 20. Yeah. This is IAS 16 and IAS 38. This is IFRS 9. Now you haven't studied these accounting standards till now, so it won't make any sense to discuss these in detail. We'll just skip this. 58 and 59. Comparability is identified as an enhancing qualitative characteristic in the conceptual framework for financial reporting. Which of the following is not to improve comparability? Not to improve comparability. Restating the financial statements of previous years when there has been a change of accounting policy. Although you haven't studied IAS 8 till now, but I can tell you that IAS 8 requires to restate your previous year's financial statements just to make them comparable. So option number A is correct, and therefore it cannot be the answer because you have to select not. This is a correct thing under IAS 8 and it cannot be the answer because we have to select not. Then, prohibiting changes of accounting policy unless required by an IFRS or to give more relevant and reliable information. This is also under IAS 8. IAS 8 does not allow entities to change their accounting policies. And why is that? Why does IAS 8 prohibit companies to change their accounting policies because they want consistency in your financial statements. And that consistency is primarily required to improve the comparability of your financial statements. And that is why IAS 8 actually prohibits changing the accounting policy. You cannot use FIFO on your inventory in 1 year and FCO in another year, then jump back to FIFO in the third year and then go on to FCO the fourth year. This is not allowed. You choose one particular accounting policy and you have to apply it with consistency. That is the consistency concept as well. So point number A and B are correct, and therefore they cannot be the options. And therefore, for sure, I'm not going to go into further detail. C and D are the correct options. You can study them on your own, but C and D have to be the correct options. Now, I am discussing in a limited manner in this particular MCQ because we still have to study IAS 8 and different accounting standards. So the in-depth understanding will be achieved a bit earlier into the course. So till that time, you just need to bear it with me. Okay. So the last MCQ of this period, and this is 59 MCQ of your Kaplan examination kit. Which of the following criticisms does not apply to historical cost financial statements during a period of rising prices? Does not apply criticism. Historical cost concept is criticized because it does not show the current cost. Yeah. Let us just skip this as well. We'll study this later on when we are done with IAS 16 and different. Let's just not confuse these matters. So many MCQs that you see in your examination kit cannot be attempted from day one. Now we are just starting our course, and it may be wise to leave some MCQs for a later stage. When we have studied some more accounting standards, then we are in a better position to understand the logics of those MCQs. So it's better to skip some MCQs for the time being so that you can do them with better understanding in future. All right. So we'll call it a day right now. We have done practice of framework till now, and I hope this was very much helpful. You guys know my numbers. You guys know where to contact me. My particulars are 92345 2745092. The easiest way to contact me is WhatsApp. However, you can LinkedIn me, you can YouTube me, you can find me on social media. You can engage with me in any case you like. All right. So take care. Allah Hafiz, my friends.